welcome to CFA Society Jamaica's inaugural forecasting webinar. My name is Stacey Ann Tate, and I am a member of CFA Society Jamaica. And this evening, I will be your moderator for this evening's forum. Now, we have with us here present members, candidates, friends of CFA Society Jamaica, others, and first-timers. Now, it is absolutely important for me to remind everyone in attendance of a key focus that CFA Society Jamaica has, and that is to be a key source of investment knowledge by promoting and
Stacey, I think you're muted.
Thank you so very much, Kerry. Good evening, ladies and gentlemen. Welcome to
Stacey, you're muted again.
Don't know what's happening with my laptop. Good evening, ladies and gentlemen. Welcome to CFA Society Jamaica's inaugural forecasting webinar. My name is Stacey Ann Tate, and I will be your moderator for this evening's forum. Now, with us this evening, we have members, candidates, friends of CFA Society, we have associates, and we have first-timers. Now, it is important for me to remind everyone in attendance here about a key focus that CFA Society Jamaica has, and that is to be a key source of investment knowledge by promoting and facilitating the open exchange of information and opinion. Ladies and gentlemen, with the agenda that we have lined up for you this evening, we promise you nothing less than that. Now, before we get started this evening, there are a few reminders that we would like to share with each other, given that we will be spending some of our time together this evening. Now, the first reminder is, during the presentation, we're going to ask that all microphones remain muted unless you are presenting. Second, in short order, you should see a poll popping up on your screen. We encourage you to spend a few seconds completing the poll, assisting us with gathering very important information. Third, we will have the delivery from our various presenters, and then when they're through, we will have a general question and answer segment. We encourage you at that time to type your questions in the chat, and one of our lovely and abled co-hosts will read your question out aloud, and then same will be fielded to the respective presenter. Lastly, it is important for me to disclose to you that our wonderful program will be recorded. Ladies and gentlemen, for us to really get started for this evening's program, I would first like to invite and welcome Mr. Brian Fraser. Mr. Brian Fraser is our president of CFA Society Jamaica. Brian, we invite you to share with us your welcome and opening remarks. Over to you.
Thanks, Stacey Ann. Let me know when you're seeing my screen. All right, good. See my screen?
Yes, we're seeing your screen, Brian.
Okay, good night and welcome everyone. We are delighted to have you at our first forecasting webinar. Before we get into the core of our agenda tonight, I would like to use just a few minutes to talk about the topic of professional learning for investment professionals and why it is important. I will just share some information from two research reports done by the CFA Institute looking at trends in our industry that will impact jobs in the industry, and just looking at the way forward for investment professionals to navigate as we go through changes in the industry. As we all know, 2020 was one for the history books, where the pandemic brought unprecedented changes to both our personal and professional lives. However, prior to the pandemic, we would have seen certain trends, especially in relations to technology, and those were really just accelerated as a result of COVID-19. And we expect some of them to become the norm even after the pandemic leaves the building. The future state of investment profession research outlines relevant megatrends across industry that will influence the state of the profession in the future. These includes demographic shifts, technological advances, macroeconomic condition, government and regulatory influences, as well as the management of resource. These were then combined with finance-specific forces to create four scenarios. I must point out these are not forecasts, but instead they are possibilities of the future. The report actually focuses on the next 5 to 10 years and reflects the view of mainly leaders and stakeholders from within the investment industry. I would say these are some of the things that keep leaders in the industry up at night, strategizing what changes to make to their firms in order to stay relevant to clients. So over on the right of the slide, these scenarios, we'll just go through them quickly. The first is fintech disruptions. And most of us would be familiar with those. We are expecting to see things like the quickening flows of disruption from technological innovations. We expect to see traditional active management shrinking, while we see more demand for smart data and outcome-oriented solutions. And we expect to see financial services becomes more personalized and digitalized, as well as seeing more robo-advisor type of services being demanded by customers. The next one alternative scenario is the parallel worlds. And the focus here is on changes in demographics. The main elements of this scenario, future scenario, will include stuff like an improvement in the financial literacy and empowerment, which produces better financial participation. We expect to see social media carrying more potency to bring people together and to divide as well, both legitimately and illegitimately. I mean, two recent widely publicized events would have utilized social media. First, the Trump insurrection, as well as the Reddit episode. We don't have time to go into those, but I think most of us would be familiar with those and see how social media plays into that. We also expect to see new style of financial institutions enabling personalized, simple, and speedy engagement. And then under the next scenario, we are all familiar with that, and this is even more so with the pandemic, where we will expect to see lower for longer interest rates. Some of the main elements or impacts to our industry. We expect to see large gaps in pension coverage, and we're talking about worldwide, situation here, not just specific or unique to Jamaica. We also expect to see, moves to lowering costs. We expect to see higher tech-based investment solutions, and we expect to see a premium being placed on innovation. And we have seen in our local industry already a more increase in demand for alternative investments, and we expect to see an increased capital raising on the private side of the market. We also expect to see investment professionals coming under increased pressure to demonstrate their value during this period. And then fourthly, the fourth scenario and final scenario is purposeful capitalism. And the main elements here, we expect to see increase in things like ESG investing, more transparency and fairness in markets, and also we expect to see fierce competition for leadership talent among investment organizations. Next slide, we see how these scenarios and trend will impact investment professionals. And CFA would have completed the second research, which is the investment professional for the future study, which was done in 2019. This outlines a roadmap for individuals to have fulfilling careers in the context of a changing industry. And this would also look at 5 to 10 years and would have included surveys of over 3,800 CFA Institute members and candidates. The report looked at changing roles, changing skills, and changing organizational culture. And one of the greatest points, or the greatest area of consensus, is that 90% of industry leaders agree roles will transform multiple times going forward, and adaptability will be very essential moving forward. 43% expect their roles to change significantly over the next 5 years. And when we look at the 4 categories of skills, technical, soft skills, leadership, and T-shaped skills, it is expected that T-shaped skills will be most important going forward. AI and HR, which will be the norm going forward, is a combination of artificial intelligence and human intelligence, as it was found that when you combine the both together, they have a multiplier effect. And lastly, nearly 80% of industry leaders expect greater change to the workplace going forward, and we'd have seen some of those precipitated by the pandemic. On the next slide, as I mentioned before, we'll see persons, were asked how much change they expect in their role, going forward. And if we'll drill down to some of the financial roles, for example, financial advisors and risk analysts, over 50% of these persons expect changes. Now, next slide looks closer at the 4 skill category and the future demand from the survey of industry leaders. Persons were asked to rank the skills within each category in terms of future importance. And what this slide is showing is that, technical skills as a category is ranked lowest, even though individual areas within that category are still ranked high, such as solution skills. And then we see soft skills moving up in terms of importance. But as I mentioned before, the takeaway is that as a category, T-shaped skills are the most important moving forward. And this slide just shows, in terms of a trend as to what CFA members and candidates are learning. And what we are seeing here is that soft skills account for most of what persons are pursuing now. However, it makes sense given that these skills are transferable across roles, while technical and other skill may not be. But we also see where there's a gap as it relates to data mechanics and analysis, as not much persons are pursuing those. So that's an opportunity. In terms of when we look at how investment professionals can chart a way forward in a changing profession, we think that they should, first of all, keep learning and adapting. Disruption will require more learning to keep up. This means putting energy into your career and will require having a growth mindset that drives you to continue to learn. There are structured learning approaches, and also we can also learn on the job. The research shows that investment professionals, you know, dedicate about 30% of their time to learning new things on the job. So if you're finding yourself dropping below that, then you may have to look at another job or pursue some other learning outside of the job. Secondly, invest in new era skills. The key is actually to have a blend of the 4 categories of skills that were shared before. And it has to be appropriate for the various stages of your career. So at the start of your career, technical skills are probably the most important relative to other skills, but later in your career, certain skills like leadership and T-shaped skills are necessary. The CFA Institute actually provides members and candidates with a career tool that will help them to complete a self-assessment and to customize a career path. So we should definitely check that out. Thirdly, individuals should strive to become more tech savvy. As we move forward, technology will be more important to all investment professionals. Everyone will have to do things differently, and they must be more comfortable using the technology. I know some of us had some challenges with the Zoom earlier, but we just need to become more technology driven to face the changes in the sector going forward. And going forward, we expect to see investment management and technology teams actually working together to produce better outcomes. And lastly, individuals should see career catalysts to guide them throughout their careers. These could be mentors, sponsors, or other forms, such as having a solid network of contacts to call upon for different purposes. In summary, the investment professionals tend to attract individuals who are passionate about knowledge. Professional learning is a source of motivation for most of us, and it is a desire for knowledge, skills, and new abilities that will propel the career forward for successful investment professional in this new paradigm shift. CFA Society Jamaica believes that as a member organization, we, along with the CFA Institute, have a responsibility to provide resource and guidance to facilitate lifelong learning, and we are committed to doing so. Simply put it, developing the investment professionals of the future is central to our mission, which is to lead and serve the investment professional locally by producing the highest standards of ethics, education, professional excellence, and best practice for the ultimate benefit of our members and the wider society. In closing, I would like to highlight that a core part of the society's activities is to deliver increased value to our members, including access to opportunities for professional learning. This includes putting on more events such as this one, where investment professionals can share important information and focus and discuss the markets. We have 2 accomplished speakers tonight. I've had the pleasure of working with both of them. They are both passionate about the investment profession and about the markets, and we are very happy to have them at this webinar to share their insights and to provide their outlook on the economy and the markets. So before I hand back over to Stacey, I just want to say again, welcome everybody to our inaugural forecasting webinar. We are happy to have you join on this webinar, and we hope that you will enjoy the presentations. Thank you.
Thank you so very much for that, Brian. Thanks for sharing the trends emerging in the investment profession and their potential impact. We really do look forward to seeing how these trends will impact the CFA curriculum in the future and how we access the curriculum. Now, ladies and gentlemen, our first presenter for the evening is a former Commonwealth Scholar, a graduate of the University of Manchester, where he obtained a PhD in international finance. He also has a Master of Science and a Bachelor of Science in Economics from the University of the West Indies. He is currently Senior Vice President and Head of Insurance and Wealth Management at Scotia Group Jamaica, where he has primary responsibility for wealth management, individual life, group life, and pension insurance businesses to support the strategic goals of Scotia Group Jamaica. He also serves as a director of the Development Bank of Jamaica and the Jamaica Stock Exchange. As a leading commentator on the Jamaican economy, he has been at the center of many private sector-led initiatives to improve macroeconomic performance in Jamaica. That, coupled with his years of experience and his academic pursuits, add to his expertise in the area that he will be addressing us on tonight. Ladies and gentlemen, I would like to introduce to you Dr. Adrian Stokes. I now invite him to address us on the theme, Jamaica's Economic Outlook for 2021 and beyond. Dr. Stokes, over to you.
Thank you, Stacey, and good afternoon, everyone. I hope you guys are hearing me. I'm seeing a little bit of a issue with the sharing. I'm not sure what's going on, but I'm going to try and share my screen so that my deck can be up on screen. I hope that you're now seeing my screen.
Yes.
Thank you. So again, let me first thank the conference organizers for their kind invitation. For the presentation, what I want to do is to take a quick look at conditions in the US economy that will serve as a good backdrop for what I will talk about in the local economy. And once I do that, then, I just want to talk quickly about, some key market developments and so on. I've been given 15 minutes and I've been reminded several times that I should stick to it. So I'm going to move quickly into the presentation. All right. So at the onset of the crisis, the COVID crisis in 2020, we saw initially a big surge in the fear index, the VIX, the volatility index, right? A big surge because investors were fearful. And simultaneously, we saw a big fall off in the S&P 500 as investors feared the worst. Since then, what we have seen is a material improvement in investor sentiment as measured by a reduction in the VIX, and you can see it there in the graph, and a surge in the S&P 500 index. A similar picture emerges or is seen if we look at the commodities market. Gold prices ran up and reached a new high at the onset of the crisis, as you can see there. And a similar thing was seen in the crude oil market, where we initially saw a steep fall off in price, followed by an upward march in recent months as economic prospects improved. Finally, in my review of the US economy, I want to take a look at what I would consider to be the most interesting market of all, the US Treasury market. Incidentally, and for all of our CFA people here and candidates, I will share a secret with you. Bond investors are considered to be among the smartest investors, certainly when it comes to the US investors. They are far better at predicting the future of the US economy compared to any investor groups, right? So if you want to know what is happening in the US economy or what the prospects will be, then a good starting point is the bond market. So interestingly enough, what we have seen is that at the onset of the crisis, Treasury yields fell precipitously, significant decline reaching record lows, right, when the crisis broke. Since then, what we have seen is a march upwards, right? Investors are becoming more confident about the future direction of the US economy. And what we have seen, therefore, is an increase in yields as investors expect future economic conditions to improve. And that's important, right? So the summary there from the US economy is that growth is expected to recover, but the recovery is likely to be tepid. How do I know this? Well, simply look at the bond market, right? If you compare the yields to a historical time series, then what you will see is that current yields are below those that we have seen in recent times. I want to jump now to look at the Jamaica situation. Excuse me. What we have seen, clearly COVID has had a significant impact on the Jamaican economy, right? And this is really just a graphical representation of that impact. Many sectors are down, but as you can see there, the hotel and tourist sector has been brutally hit, right? Significant impact there with the COVID and given the nature of those two sectors of the economy. The fall off in real output is also evident when you look at the fiscal situation, right? What we have seen is that COVID has blown a big hole in the fiscal deficit to the order of about $70 billion, right? And the primary surplus actually, right? The key primary surplus, if you look at the primary surplus and compare it year over year, you will see that there has also been a significant decline year over year in the primary surplus, a key development. The fallout in the economy has been widespread, as you can see from the tax categories, right? Significant reduction in most of the categories when compared to the previous period, right? So the COVID impact is absolutely real. The good thing so far, right? The good thing so far is that interest rates, or specifically Jamaican dollar interest rates, are well behaved, notwithstanding the significant fallout that we're seeing in the fiscal accounts. Historically, what you would have seen is that a large fiscal deficit would have led to a material increase in yields, right? So on this occasion, however, rates have remained significantly low. And that's a key development that I will come back to later on. Now, inflation has been well behaved, right? And is expected to remain so, right? Very, 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 very important. In fact, one of the reasons why the central bank has been able to run an expansive monetary policy and for rates to remain low is that inflation is low and is expected to remain low given the conditions in the labor market. Unemployment rate is trending above 12%, expected to remain at elevated levels for a while, and therefore there is no significant pressure for inflation to trend higher. Now, headline inflation, in other words, inflation including food and energy, will spike and will oscillate over time because of the volatility in food inflation and energy inflation. But when you strip those out and you look at core inflation, we expect core inflation to be well behaved over time, as I indicated, because of what's happening in the labor market, right? No pressure whatsoever in the labor market, given the significant slack there, and therefore we will expect inflation to remain range bound in the central bank 4 to 6% range. So that's important, and that's one of the reasons why the central bank has been able to keep this expansive monetary stance that it has been on, in effect, what that means in layman's term is that there's a significant amount of Jamaican dollar liquidity in the market. The other reason why the central bank has been able to keep rates low and continue on its expansive monetary policy is exactly because net international reserves have been relatively healthy, right? And that is significant. So notwithstanding the sudden stop in receipts from tourism flows, right? That has been absolutely devastating, right? Tourism brings in excess of $3 billion US per year, and over 80% of that has vaporized given the COVID situation. But net international reserves continue to remain strong. Why? Remittances have been robust. It was something that many of us missed, certainly at the start of the crisis. I remember the PSOJ, we sat down and we were trying to model the balance of payment impact of the crisis. And we came up with a funding deficit, a funding gap in excess of $1 billion. And one of the reasons for that was obviously what was happening with tourism. And when we looked at remittances, we expected a decline, not a significant, we expected a modest decline in remittances, right? However, we have actually seen the opposite. Up to about October of 2020, remittances are up over $400 million US on a year-on-year basis, massive. And that's helping to keep the balance of payment funded. That's big, right? The fact that remittances have surged and is continuing to support the external situation. And in truth and in fact, we shouldn't be completely surprised at that development, given what's happening in the major source markets, in particular the US, right? The stimulus measures that we had earlier this year, notwithstanding the fallout that we've seen in that economy, they have been able to buttress some of that fallout by sending checks to people. And we expect a similar situation to play out in the coming weeks as the US Congress debates the new stimulus package. So remittances have been strong and they have supported our external situation. In the past, what we would have seen from this significant sudden stop in tourism flow is a balance of payment crisis, right? What we saw in the 2008-2010 period, we would have had a currency crisis where the currency would have depreciated significantly. We have not seen any of those things because of the performance of remittances. Another view of what I've just said is to look at the real exchange rate, right? And again, in layman's term, what a real exchange rate measures is the competitiveness of the economy. And there are two important variables there. We have the nominal exchange rate and we have the inflation rate, right? And inflation has been, we have the nominal exchange rate, I should say, and we have inflation, right? Relative inflation between the US and Jamaica. What we are seeing is that the real exchange rate is well behaved. We are not seeing any significant overvaluation in the real exchange rate. And that's actually very important. In fact, in my past life, when I was actively trading, one of the things that we would look at to get a sense of a currency crisis or a balance of payment crisis is to measure the real exchange rate. And if there was a significant overvaluation, then as night shall follow day, there would have been a serious and violent correction in the Jamaican dollar. We're not seeing that this time, right? And that is because of two major factors. One, the situation with inflation remains well behaved. And as I indicated, we do not expect inflation to spike given what's happening in the labor market in particular, and that there's zero inflation pressure coming from the labor market. Not to say, and I just want to put this out there, that headline inflation, that is inflation that includes food and energy, that will oscillate. In other words, you will have some spike from time to time, given the volatility in food and energy, but core inflation is expected to be well behaved. So a key punchline in terms of what I've been saying so far. Jamaica's situation, as represented by our external balance, as indicated by our net international reserve, remains fairly strong, and that is supported by the remittance, the strong situation with remittances. The monetary stance of the central bank, and which has created a very low Jamaican dollar interest rate scenario, means that our twin deficit, the fiscal deficit and the current account deficit, are easily funded by the government. If you don't believe me, again, look at the bond market, right? Very, very smart bond investors, and look at what's happening to spreads on Government of Jamaica bonds. Again, they would have risen significantly. They rose significantly at the onset of the crisis last year. And since then, they have actually fallen to record lows, right? Spreads on German assets have tightened significantly. Why? Because the external situation is very sustainable, as reflected by the real exchange rate, the net international reserves, the movement in the nominal exchange rate, and the fact that the market believes from a local dollar perspective, the government can fund its deficit. Notwithstanding all of that rosy story that I've just painted, there are significant headwinds for the government of Jamaica and the Jamaican economy in general. If you look at credit to the private sector, it has slumped, and importantly, the growth in credit to the private sector, it has slumped materially. Credit growth is a leading economic indicator. It tells, certainly within a 1 to 2 year span, what we expect to happen to the economy. Again, this is a forecasting webinar, so this is a key input into your forecast. What's happening in the credit market, and in particular, loans from commercial banks to the private sector. And if you look at household, what's happening to credit to households in particular, that has fallen off significantly, which is a problem for near-term growth prospects. I suspect I'm running up close to my 15 minutes, so I'm going to move to closing arguments. So the first thing I want to do is to reiterate the external situation, particular what's happening in the US economy. As indicated by the treasury market, the bond market, recovery is expected. However, that recovery is tepid. And again, remember the clue, how I arrived at this conclusion. I simply look at what's happening with yields and compare that, look at it on a time series basis, right? And the fact that yields are currently below recent levels is a big indication in terms of how the bond market is seeing the recovery. That's very, very important. Locally, our situation is better than many of us would have expected. Our twin deficits are manageable, they're fundable, and therefore, at least in the near term, is sustainable, right? The COVID situation and the curfews and the measures that we have had to implement to stave off the spread of the virus, clearly that's having a deleterious impact on the economy and will continue to be that way for the very near term, right? Clearly, things like vaccination rates and so on is going to be important in terms of the future direction and the anticipated pace of recovery. One important point that I want to highlight before I close, sorry, is the debt to GDP level. I didn't go in much into debt to GDP and unpack that because of limited time, but suffice to say, we expect the debt level to be above 100% by March 2020. Now, that's massively important. That's a massive development. Before COVID, we were expecting debt to be firmly below 100% of GDP by now. So what we have seen is a material reversal occasioned by the spread of the virus. So we expect debt to GDP come March 2020 to be at least 110%. That's significant. That's significant for a whole host of reasons. One in particular is because the debt level represents a binding constraint on what the government can do. In other words, traditionally you would expect in a slump like this for the government to implement material countercyclical measures to revive and resuscitate the economy. Government has no such degrees of freedom to implement material countercyclical policies. It may tinker and do a couple of grants and so on and so forth, but certainly relative to GDP, any such movement will be fairly immaterial. So the debt situation is important, right? Debt, as I indicated, will be materially above 100. And in fact, the risk is skewed to the downside in terms of the future trajectory of the debt to GDP level. In other words, in layman's term, the debt could even be above 110% by the close of the next fiscal year. That is actually very, very important for us to recognize. What I want to close by saying is that over the next 6 months, and I've limited the forecast to that horizon because of major uncertainty as it relates to vaccination rate and just what's happening on the COVID front. So within the next 6 months, I would say that the major macro variables will remain well behaved. And by major macro variables, I mean, the exchange rate. I do not expect any material nominal depreciation in the Jamaican dollar versus the USD, right? The NIR is pretty healthy. It will remain around 2.9 billion thereabouts, certainly come the end of March and going into the new GOJ fiscal year. You will have oscillation or volatility as you move to quarter end and financial institutions do balance sheet management and so on and so forth. But on a longer term period, in other words, when you look at it on a 12-month period, I do not expect any material depreciation in the GMD USD rate. I expect inflation to be range bound, to be largely within the central bank's 4 to 6% horizon. And again, that's based on what's happening in the labor market, significant slack there, and therefore wage pressure is very, very low, and therefore overall inflation expectation will be well contained over the next 6 months in particular, right? Interest rates, again, I expect interest rates to continue to be low, even with pressure to the downside in terms of the risk. Why? Because the BOJ can continue, given what's happening with the external situation being sustainable, spreads are low, there's no significant pressure on the Bank of Jamaica to change its monetary stance, and therefore we expect ample JDOLAR liquidity to remain in the market. That's going to be very supportive of asset prices, in particular JDOLAR asset prices, right? And that should be an expectation over the next 6 months. And I would even venture to say over the next 6 to 12 months. So thank you. And that represents the core of what I wanted to speak about today. And I now hand back to Stacey, and thank you very much.
Thank you very much, Dr. Stokes. Very informative. We certainly loved how you made the connection between the US market, the source market, and then how it affects us here. And then we have the pleasure of picking your brain some more in the question and answer segment. Ladies and gentlemen, actually, we may have to bring that forward unavoidably. Our next presenter had an emergency, and we wish that everything else with him is okay. However, it is quite likely that he may not be able to attend tonight. But although we will miss him because he had a package for you, the good thing about the forum that we're at is when we have a star-studded lineup, it's very easy to find fill-ins to be able to assist. So other members of the CFA Society will also contribute to the question and answer segment that we will actually move into now. So Adrian, I'm going to ask you the question that everybody has been asking and multiple persons have been writing about. When do you think that we will start to see the Jamaican economy recover?
Right. If I knew, I wouldn't actually tell you. I would put on some trades first and, and then reveal afterwards. Um, so, that is obviously what is on everyone's mind, right? In terms of how I have been looking at it, and certainly in my own business, I've been saying Q3 to Q4 this year in terms of calendar quarters is where I would expect to see material or noticeable recovery in the economy, starting to see that, right? I believe, with the spread of the virus, and you're seeing what's happening in Jamaica right now with all the containment measures. I'm not a doctor, but I expect that's going to continue to have an impact. I expect in the source markets in Canada and the UK and the US, their vaccination drive will become material around summer. They would have had, I would say, a lot of their population vaccinated, and then that's going to help travel, right? But Q3, Q4 is when I would expect to see the Jamaican economy starting to benefit from the vaccination drive globally, certainly in terms of the recovery or the easing of the travel restrictions. But certainly going into 2022, right, is when, realistically, we should begin to get answers, better answers, or the future will become a lot clearer going into 2022, right? So that would be my kind of best guesstimate to you.
Okay. So we will look out, sorry, we'll look out to see what happens in Q4 and we hold you to that. Now, when we think about the economic conditions here in Jamaica, of course, our heart goes out for the people or for the segment that is tourism. And when you think about it, they're so hard hit, as you would have mentioned. How do you see them getting support? Because even if a vaccine is to be ready in the source market and fully deployed into the end of this year, I mean, let's face it, it will take a while to get to us and to inoculate everyone, as well as to get people back on aircrafts in the droves that they were before. So talk to me a little bit about the sector and what you think they will need in terms of support to be able to turn that sector around.
Yeah, it's going to be tough. It's clearly is a very tough situation as far as tourism is concerned. And as you rightly said, I do not expect to see any significant recovery. Certainly not before Q4 and going into 2022, before you see any kind of decent arrivals in the sector. In terms of what can be done, I outlined the situation with our fiscal. There's a big hole that's blown there. The debt level that I indicated is well and truly above 100%. In fact, we expect it to be about 110% or even slightly above 110% by March 2020. That, as I indicated, is a binding constraint in terms of what the government can do to help any sector, quite frankly. And that's why I spent a little bit of time talking about the debt and the constraints that will occasion for government of Jamaica. So I believe, therefore, that what government will have to do is through policy, right, as opposed to through direct revenue intervention, right? For example, even if there were to be a second round of, let's say, checks going to tourism workers, I don't expect it to be meaningful, right? Because of the fiscal situation and the debt level. So it's difficult, a very, very difficult situation. We don't have a lot of money to play around with, and in terms of helping various sectors. And so really, And just to broaden the discussion, what the government has to do is to ensure like sectors like construction, which we're actually seeing decent activity in construction. It's actually going gangbusters right now, and it is employing a number of persons, right? And that will help, right? That will help the overall employment situation in the country, and it also help the coffers. What policy needs to do is to look at what else we can do for other sectors that are not so COVID exposed, from a service or interaction perspective, right? And to see how can we enhance activities in those sectors, right? And think about it from a macro perspective as opposed to sectorally trying to help the tourism sector. Tourism will recover. It will go through a difficult period as it is going through right now. The size of the problem is big, which means it is beyond, I suspect, any material direct financial relief from central government. And therefore the economy and enhancing other areas of the economy, for example, like construction, will have to be the solution that government of Jamaica looks at.
Thank you very much. Very informative. To my co-hosts, could you please check for me in the chat? I think I saw 1 or 2 questions coming in from the audience. And I think the first one I'm seeing here from the audience, it says, what are the key sectors to watch coming out of the downturn?
Right. I never like to pick sectors, but as a trader and in my former life, what I personally, I like to look at things that are really badly beaten up. So, I would look at sectors that have had a really rough time of it right now, and try to look at, to develop what I would call key indicators, right? Key indicators of recovery in those sectors, and try to take my risk on that basis, right? So clearly, the tourism sector, entertainment in particular, right? If you have a long view, right, those sectors have been beaten up pretty badly, and presumably, if you're a value investor, if you're looking for cheap things, right, and you have a longer term horizon, then obviously that is something that you want to look at. But then again, as CFA people, you should remember the key principle of diversification in terms of managing your risk. and so therefore, sectoral views, just be very careful when you're constructing your portfolios, right, to have a fair amount of diversification, and take your horizon, ensure that you understand what your risk parameters are.
Thank you. And the other question in the chat, it asks, what's your view on the government's handling of the virus measures and the impact on the private sector?
Wow, you're taking me out of my comfort zone.
That's what the people want.
You have taken me out of my comfort zone. But what I would say is it's a very difficult situation, right? There is no manual or playbook for managing COVID. A lot of it is learning by doing, and really laying the track and driving the train as you go along, right? Correcting. And so that's the experience that we have seen worldwide, and that has also been our experience locally. So for me, it's learning by doing, right? Trying things, see how it impacts the economy, how it impacts the overall health situation, and correcting. The important thing is to adjust quickly. If something happens and it's not working or working as intended, then the question is the speed of how quickly we change course. So that's the best answer I can give you without getting seriously outside of my comfort zone and running into problems with people I shouldn't have problems with.
Understood. There's a new question in the chat, and this question asks, what is your assessment of a potential surprise upswing in inflation in the US economy?
It's going to be hard. Even the US economy to have inflation. But what I would say is that in a perverse way, it's certainly in the US economy, it will be good to have inflation, right? Now, what do I mean by that? Why am I saying it's good to have inflation? So it will be good to have inflation in the US economy, largely because that would be reflective of a couple of things. Generally, an economy that is going gangbusters, and particularly a labor market that's also very tight. Those are the conditions, are the preconditions for higher inflation, right? So if we're surprised by higher inflation in the US, then it's not the end of the world. In fact, it would be a good thing. It would be a good thing for the Fed to deal with. And I would hasten to say that when you look at the balance of risk in terms of higher inflation versus deflation, and in fact, that's an important debate that's happening in the US right now in terms of what the size of the stimulus should be, right? As you know, the new president has tabled a package. Some members of Congress are saying, listen, that's too big, and we need to have a smaller number and have it more targeted. But then when you look at the balance of risk in terms of how you make decisions, should you have it too large? If the measures turn out to be too large, you may have inflation. However, if it turns out to be too small, you may have stagnation and deflation. Which do I prefer? And any person who understands markets and economies and so on will tell you, what? At this point in time, I would err on the side of having more inflation. That's easier to deal with than having deflation.
Yes, definitely so. So, Adrian, you spoke about credit falling off, and I have a concern. Before COVID, we weren't seeing much growth. Growth has been eluding us for a very long time. What are those catalysts that we will need now to drive economic growth, especially too that we're starting even behind the eight ball? Because if we weren't really achieving it before and we now have COVID, how do we move to actually seeing the real growth levels that we really want to see?
Yeah, we don't have, trust me, we don't have enough time to talk about growth in the Jamaican economy and why we have had low growth for such a long time. But what I would say is the following. So leading up to COVID, certainly going into 2020, the Jamaican economy benefited from a period of macroeconomic stability. It was the first time in a very long time that we had a situation where the fiscal situation was well managed. The trajectory was very good. On the external side, the situation was, again, very sustainable. Current account deficit was coming in, the reserves were building, and most, or I should say, all the macro variables were in unison. The first in a very long time that we saw that. And that really set the pace for significant job growth that we saw in the Jamaican economy. That was actually a big positive. And we started to see, and you can see that the many deals that took off over the last 5 years, many companies started, private equity, people doing all kind of fandangos in the market, which is important, is an important part of economic growth and development, right? Innovation, right? We started to see the innovation in the market because we had macroeconomic stability. The government came out of the market, people could take risk, right? The credit risk premium came down for Jaman, and the market started to function in an innovative way. Now, undoubtedly, there's a lot of froth or things that are not worth what people are saying, but that's fine. The market will find people out, and that will solve itself. But by and large, right, we had the conditions that was generating growth, not strong growth. So how do we achieve faster growth in the economy? So it's really one of the keys to that is we have to get more of our Jamaican people involved in the economy. That's the first prerequisite, right? People is an important part of the growth equation.
Mhm.
So we have to get more people involved. And not just involved, is that we have to get more people involved in a way where their productivity is increasing. We have had a productivity problem in Jamaica, right? So the first thing is to get them involved. The second thing is to increase their productivity, right? And we were on the road to do that before COVID, and we have to continue. So in wrapping up, we have to continue to do a lot of the things that were being done before COVID. They were the right things, right? And we have to continue to do those things. We have to recover from COVID, which means the government has to resist the temptation to go gangbuster with its fiscal account. No doubt, it will be under pressure, sectorial pressure to do something, right? To spend, to do something. I'm sure that it will face that pressure, but I will say that will not be the smart thing to do, right? That's definitely will not be the smart. It will not be in the long-term interest of growth and development. The government has to maintain its discipline and really, as I indicated earlier, focus on policy, right? Implementing a policy framework that is growth enhancing and levels the playing field for everybody, and importantly, fosters innovation, right? Let the private sector take risks. Let us continue with a lot of the new things that are happening in the market. Some of those will succeed, some will fail, but that's fine. That's part of a normal market. And out of that process, right, I believe we will get better growth. I mean, it's a much more involved story than what I've said here, but that's the shorter version, even though I've gone on for a little bit.
That's fine, thanks. It's a subject that a lot can be said on. And I'm sure there are also varying opinions that actually would be put up against that, but then that's fine. Now, let me take a question from the chat. And this one is a very long one. So let me start. It says, with the unprecedented fiscal and monetary measures worldwide, how do you see the eventual unraveling or eventual reversal of those measures playing out, especially with the risk of it potentially being disorderly in at least some areas of the world? It's a lot, so let me go again.
Yes.
With the unprecedented fiscal and monetary measures worldwide, how do you see the eventual unraveling or eventual reversal of those measures playing out, especially with the risk of it being potentially disorderly?
Right. Yeah, no, great question. But the good thing is that we have a lot of experience actually, coming from the last crisis, right? Remember when we thought that the Great Recession was was like the worst thing that we have seen and so on and so forth. And we had the Fed and the ECB and most of the major central banks doing innovative things and so on. Quantitative easing became a buzzword and the Fed balance sheet blew up, and that was one of the questions actually, how the Fed would unwind its balance sheet given all the things that it was doing to support the US economy and ultimately global growth. But we never really had a problem, right? We never really had a problem in terms of unwinding the Fed's balance sheet, normalizing or moving to a more normal monetary policy. In fact, we were, and the US was well on its way to bring down the Fed's balance sheet. Now, obviously, it is something that will have to be done with a lot of care. But as I indicated, the fact that we went through the 2008 crisis, where we had a lot of stimulus measures and a lot of monetary innovation, we have a lot of experience in terms of unwinding some of those positions. The key is, and I want to make this point. Now, this recession that we're going through, it's a man-made recession in a way, right? Man-made because we have actually put in place measures to stop economic activity. For example, like curfew hours. So we have literally looked at the Jamaican economy and say, you know what, we're closing it down for a quarter of the day. That's something that we have done. Businesses haven't failed. It wasn't because we had failures in the tourism sector or the entertainment sector or so on and so forth. we actually took decisions to stop economic activity. I'm saying that because we will equally, have measures to open back economic activity. The key here, the key unknown that we have to think through is permanent damage. How much permanent damage is being done right now from the measures that we have implemented to stop the economy? Right? In other words, how much demand destruction, supply destruction is being created due to man-made policies occasioned by COVID, right? And for me, I believe that is the real risk that the world faces right now in terms of permanent destruction from what was supposed to be temporary measures to stop the COVID spread.
Thank you. Another question from the chat asks, do you think we could look into investing more in agriculture, food, storage, and export to boost our earnings as a country?
Yeah, no, absolutely. That's always a possibility for us to do that. In fact, before COVID, one of the things that we're getting better at is linkages, in particular the link between the agricultural sector and the tourism sector, and for the tourism sector to buy more from the agricultural sector. That was, there was a lot of activity there in terms of boosting the demand for local production. And certainly, that's one of the ways when I talked about, government of Jamaica not necessarily looking at financial remedies, direct financial remedies to tourism, but look at other ways to stimulate the wider economy. It should be thinking, okay, what from a policy perspective can we do to boost agricultural output, and not just boost output, but have better coordination in agricultural output. As you know, right now, I was listening to news, for example, about 2 nights ago, where a month ago, and it's funny because something always happened. A month ago, we were short with tomatoes, right? That, it was very expensive and you could hardly find any. And, I was watching TV and saw farmers in St. Elizabeth, and they had too much tomatoes and they had to be feeding tomatoes to animals and so on and so forth. So that's a problem, right? That coordination problem, right? Storage problem. RADA has to do a better job at that coordination. And that alone actually could boost agricultural output, right? Help to stabilize prices, because what we have a lot of volatility in agricultural prices, which actually you will see in the headline inflation number. And simply by finding ways to stabilize prices and not having this kind of significant spike and peaks and troughs will actually boost output, because farmers will have better confidence in planting, know when to plant and so on and so forth. You have better storage, right? Better consistency. And also, because one of the things that when you're going to export, right, you need predictability. People who are buying abroad need to ensure that you can deliver, quantity, quality on a consistent basis. So absolutely, I think many of our people actually are involved in agriculture, and that's one of the areas where I think we can improve, and that area can add to Jamaica's overall growth as well.
Thank you. We have two questions from the chat also, and I do think they're related. The first question is, where are the opportunities for investing in this pandemic? And the other is, which asset class, if any, has shown to be pandemic proof?
Yeah. So, I mean, what I would say is, first and foremost, take the long view, right? And if you go back to 2008 and you looked at the markets, and you were living in that world, and I was there, I was right in the middle of it, and you only saw doom and gloom. And if you compare prices now, asset prices now to asset prices back in 2008, if you had put your money down in 2008, you'd have been retired by now. So the key there is to take the long view, right? That's very, very important when you're a CFA people. when you're talking about investment, and ensure that you're diversified, right? You want to do that. I mean, in terms of, COVID or pandemic proof or so on, I mean, online businesses have clearly done well. If you look at things like Amazon, for example, have clearly done well in terms of, people online shopping, and, those types of sectors and industries have traditionally, done well. People still have to eat, people still have to, so if you think about it, you can actually come up with sectors that will do well. But as I said, it's, as an investor, it's very easy to be fearful and be caught in the now, right? And a lot of us do that, right? So greed and fear are the two emotions that you have to manage as an investor, right? Greed and fear. And many people will tell you that when people are fearful, then that's the time for you to go out and start to look for opportunities. And importantly, and what that is saying in a different way, so take the long view, right? COVID will be solved at some point, right? Another year, another 2 years, and so on. The world will move on, right? 10 years from now, you're gonna look back and like, crap, if I had bought this, or invested in that, or so on and so forth. When you look at the prices between now and 5 years forward, it's going to be night and day. So take the long view, diversify, very important. All right. Ensure that you understand your investment objectives and principles and so on. Have a clear risk management framework in place, how to manage your risk. And, just ensure that you are not just doing things because you're fearful.
Thank you. And my last question for you, I see no other question in the chat, but I feel like we have really been drilling you and we're getting good information from you. Now, you have a seat at the table, and there has been a lot of talk about financial inclusion, and especially too from the Ministry of Finance and also its stakeholders, the regulators. Everybody has been talking about improving financial inclusion. And a part of financial inclusion, the BOJ has decided that it will test a digital currency. Now, Adrian, tell us a little bit why financial inclusion and possibly this digital currency that the Bank of Jamaica wants to establish will help with growth and financial inclusion.
Yeah, so great question, great question. So recall when I said one of the ways to boost growth is to get more people involved in the economy, right? And importantly, a lot of Jamaicans are not included in the formal sector, right? The formal economy. For example, they don't have a bank account. They don't have no financial records, right? So there's no basis to offer them credit, for example, right? Without an ability to borrow, you're very limited in terms of your own financial situation, right? How many of us could have bought a home or a car or any asset without being able to leverage our position? And many Jamaicans can't access credit, right? And that's why, interestingly, the NIDS, is actually a very important piece of legislation and an important tool when we talk about financial inclusion, because that's one of the ways where we will start to break down some of the informality in the Jamaican economy. It's too informal. And as you know, we are in the banking sector. It's hard to bank informality from a regulatory perspective. You just can't. The digital currency bit is a way, I suspect, for the Bank of Jamaica to enhance access to finance, to financial services, right? I suspect that's the angle that you're looking at in terms of people accessing the formal financial system. But that's key in an economy like ours, where it's a very big hustling culture, i.e. a lot of informality, right? The key is, how do you leverage those people, or how do you include those people so that they can participate in the formal economy and access things, for example, like credit, right? So a man has a little a jerk pan. He jerks chicken and so on. May not seem like a big business, but actually when you think through it, Monday to Friday on the weekends and so on and so forth, before COVID, that man actually generates serious cash flow, right? The problem that he can't prove it, if he were to walk into Scotia, NCB and so on and so forth, there's no track record because he really keeps his money at his house, and so he has no way of showing a history of his business and so on. Therefore, he can't borrow to improve or increase his output of jerk chicken, right? And that's why financial inclusion is massively important and is a key part of what we have to do to drive faster growth in the Jamaican economy.
Thank you so very much, Dr. Stokes. It has been a thrilling session. It has been quite relatable, and we love the way how you were able to break down the content and for us to drill you. In fact, the other star-studied persons that I was going to call, and I'm sure they're happy that I drilled you instead of them. But I just want to say thank you so very much. It was a very informative session, and no doubt the audience would have benefited too. So, ladies and gentlemen, this pretty much brings us to the winding down of our session this afternoon, where we're forecasting and charting the way for Jamaica going forward. Now, to wind down further, I am going to invite Mr. Hugh Miller to address us with our closing remarks. Hugh, over to you.
Hugh, you're muted.
Oh, that's a rookie mistake. My apologies. Thank you, Stacey, and good evening, all. I'll be moving the voter thanks as well as sharing some very important information with you. So please don't tune me out and please just jump off. And importantly, voter thanks will just be a minute. So I know like Sharon Lawrence and those people can suffer through it. So we want to first thank our president, Brian Fraser, just for giving us just his assessment in terms of the change in roles, the change in skills, the change in organizational culture. But importantly, also giving us a roadmap that will empower us as we seek to concretize our personal development plans, and take our careers to the next level. Also want to thank Dr. Adrian Stokes for providing a succinct but clear assessment and outlook of both the economic and the financial landscape, locally and internationally, as well as just touching on some of the emerging structural trends. As you know, we're moving in a low-touch economy. Also want to especially thank him for extending himself and pivoting so that you weren't shortchanged with the unavoidable absence of our other presenter, Jason Morris. I want to thank the moderator for keeping everybody in rapt attention and also just in pivoting in terms of in the context of Jason's absence, but just ensuring that when we hit that leave button in another 2 minutes, we can say it was time well spent. Important, I want to thank you, the participant, for remaining engaged, as well as just for your questions, which I think contributed to mutual learning. And so I just said to you, participant, before you log off, you'll be seeing 2 poll questions. They'll only take you 2 minutes, and then you can log off to have your evening snack. And so last but not least, I just want to assure you that as a director of CFA Society Jamaica, as a member also, I want to assure you that we continue to bring you content which we believe is relevant to your professional considerations. So until we meet again, just ask you to be safe and maintain a positive mindset. So you'll be seeing the poll questions launch. You can just attend to them, and then the rest of the evening is yours. So thank you, good evening, and it was good to have you. Can we have the poll questions?
Don't leave yet. Don't leave yet. Don't leave yet.